Are you better off trading the stock market or the Forex market? Now, I know this is quite a generic question, but it is one that I come across time and time again. So today, I want to look at this in some more detail so that you can get an idea of what the advantages and disadvantages are of both. Then you can make your decision which way you want to go. Hi there, here we are back in sunny England. For those of you that have been wondering where I've been for the last 3 weeks or so, I've been off the airwaves. I've actually been on my annual vacation to the Philippine Islands, flying around and exploring. There are in fact 7,200 islands that make up the Philippine Islands, and I was able to explore just 4 of them. So here's to next year, see if we can take in a few more. Before I continue on this very important topic of what's the preferred route to trade, either the Forex or the stock market, I want to remind you to subscribe to my channel if you haven't already done so. Now, over the last couple of years, I put together a whole bunch of educational videos, all free. Once you subscribe to the channel, they'll all be there at your fingertips to explore in your own time. Also, don't forget to hit the notification icon. That way, you're going to be notified the moment a new video has been released. Okay, let's get straight into it. So what is the best to trade? Well, let me say, I think this really does come down to your personal objective as much as anything. Right, so what is the best approach? Well, generally speaking, and I mean this in really general terms, stock market investing is for the longer term. So for example, if you have a longer term objective, say a 5 to 10 year plan, you might want to look to fund a pension or indeed pay for school fees. Then generally speaking, trading the stocks will be the preferred approach. If you can find some stocks with some decent balance sheets, some decent price earnings ratios, and a decent outlook with a good customer base and a sound business model, then that again could be the preferred approach. Think about it for a moment. Most pension funds that make up the pension industry are made up of stocks and bonds, a combination of the two. Very rarely do you see a pension fund made up of foreign exchange exposure, unless it's there to hedge, of course. So stocks are generally used for more longer term investment. If, on the other hand, your objective is shorter term, perhaps you're looking to supplement your income, possibly giving up your day job altogether and become a full-time trader, then in that case, maybe Forex might be the preferred approach, and that is for a number of reasons. First of all, I would say this. If you're trading the stock market, there are literally thousands and thousands of different stocks available to trade, globally of course. If you look at the S&P, for example, that's made up of 500 US top stocks. The Russell Index made up of 3,000 stocks, and of course that's just in the United States alone. The same in the UK and around Europe, the stock market is made up of multiple stocks. Getting a grasp, a handle on any one individual stock could be quite difficult. You've got to do a lot of research. However, if you're inclined to be able to do this research, if you've got the know-how and you've got the experience that you can analyze company data, you can analyze balance sheets, then of course stocks can be very profitable. But there's a whole bunch of stocks out there that you need to do this work on and this analysis on. If, on the other hand, you look at the Forex market, now the Forex market is generally made up of, say, 10 different currency pairs. So you can actually spend a lot less time analyzing an individual currency pair than the vast array of stocks available out there. But again, it does depend on personal objective and of course the amount of time that you can allocate to this. Also, if you're inclined to be a fundamental trader basically looks at the reasons why a stock or indeed a currency pair will move. If you are a fundamental trader, then of course trading stocks may be the preferred way to go, because the fundamentals are a lot easier to potentially understand than possibly the Forex market. Certainly if you understand how to read a company balance sheet and so forth. If, on the other hand, you want to be a technical trader, then I would suggest that the Forex market might be easier. The Forex market is huge. It has a massive participation, over $5 trillion a day, made up of retail and of course institutional players. Now, the other thing that you need to consider is the ease of access. It's far easier when starting off to access the Forex market than it is the stock market. Now, often people that are coming into trading for the first time only have a limited, or only want to risk a limited amount of money when getting going to see if trading is for them or not. Now, when you start trading the Forex market, you can start with just a few $100s. Very difficult to do that in the stock market. Many brokers won't allow you even to open an account to trade stocks unless you have a few $1,000s to get going. It's significantly higher than opening up a Forex account. Now, the other thing that you have to consider is leverage. If you're starting off with just $1,000, then of course the Forex market offers leverage, sometimes insane amounts of leverage. Now, I don't encourage anyone to trade with insane amounts of leverage. In the old days, they used to be able to offer 200, 500 to 1. I think that's absolutely ludicrous. My other video talks about this. You should be trading leverage of really nothing more than really 20 to 1. The recent ESMA regulations in Europe, in fact, pulled down the leverage that's permitted. But when you're trading the Forex market, you have access to huge leverage. So you can start off with just $1,000. If you're trading 20 to 1 leverage, you're basically exposing yourself to $20,000 in the market. That's not as easy to do when you're trading the stock market. So you need a higher amount of money to start with when you're trading the stocks. And certainly if you're learning, then you may not want to risk a higher amount when getting going to deciding whether or not trading is for you or not. So leverage is available in the Forex market, much more so than in the stock market, and certainly you can start experimenting with small amounts of money to see if you are indeed have what it takes to be a trader. The cost of trading, generally speaking, is cheaper in the Forex market. You might just pay a commission, small commission, and indeed the spread. In some cases, you won't pay any commission at all, you'll just pay the spread. In stocks, it's almost certain you're going to spend money on the spread as well as a decent sized commission, certainly more than the Forex market in most cases. And if you're starting off in trading, you're deciding if this is going to be right for you, you're finding your feet, the last thing you want to be doing is competing against the broker with the fees and the spreads and the commissions as well. Now, the Forex market is open 24 hours a day. So no matter what time zone you're in, there's always going to be a market open, of course, not on weekends. Now, certain times of the day will be more liquid, of course, but of course you can trade different currencies in different time zones to fit in with where the liquidity is. You can also fit in to your lifestyle. If you've got a day job, what have you, maybe a shift worker, or maybe only have a few hours a day in the evening. Now, if you're trading the stocks, for example, stock markets are generally open from 8 till 4. Once the stock market's closed, you can't trade. So if you want to trade the US stock market, generally speaking, you've got to be there when the US stock market is open, specific times. Now, the next thing you need to consider is the liquidity. Now, the major Forex pairs generally have super large liquidity. Certainly the euro against the US dollar, which is the most actively traded currency pair out there. This means that you can always get out of a position, whether it's for a profit or for a loss, without too much slippage, which is basically the difference in the price that you see on the screen to the price that you get filled at. Now, sometimes in the stocks, certainly in the lower cap stocks, this liquidity is not always there, which means the slippage could be higher. Sometimes you're in a position you want to get out and you can't get out because the liquidity has dried up. So what you see on the screen isn't necessarily what you get. But on smaller accounts, this liquidity can really affect you. The last thing you want to be doing is losing money on the slippage. Now, of course, the higher cap stocks, they have normally higher liquidity. But the higher cap stocks generally means that the price of the stock is going to be higher. If the price of stock is higher, the chances are when you're starting off in trading a smaller account, you're not going to be able to get much exposure because of the price of the stock is higher. So liquidity is a main factor. Super high liquidity in the Forex market, sometimes not as high liquidity in the stock market. If there is high liquidity, generally the cost of the stock is higher, meaning your exposure to that stock is going to be limited. Now, if you are inclined to be a technical trader, now a technical trader looks at previous price action and looks for patterns to repeat themselves. They look at charts to see where prices been in the past, to see where prices may go in the future. Now, in my opinion, and this really is just my opinion, that the technical traders are more angled to the Forex market than they are the stock market. Why? Because the Forex market is the largest market on the planet. It actually equates to $5 trillion a day. So the key levels of support and resistance, I think, are more respected in the Forex market because there's many more players than there are in the stock market, which is maybe generally driven by fundamentals more so than the technicals. As I said, this really is a personal choice based on objectives and based on your character. Are you more likely to be a fundamental trader where you're looking to analyze company balance sheets and looking for price earnings ratios and looking at markets in general, or are you more likely to be a technical trader, in which case I think that the Forex market might be a preferred way to go. Certainly if you're starting off, the ease of access, the liquidity sways the Forex market all day long for me. For those that don't know me, I started my trading career over 30 years ago in the city of London. Standing there in the trading pits. Look at that guy there with all that hair, isn't that amazing? For me, the migration from the pits to the screens was quite easy because of the Forex market. I didn't have all the knowledge about company balance sheets and didn't have that experience. For me, I purely looked at price. For me, trading the Forex market is much more akin to trading that I grew up with in the trading pits. That's why I've chosen the Forex market. That's why it gives me the best opportunity, because it's something that I've grown up with. Whatever choice you decide, I hope you are successful. As always, if you liked my video, give me a thumbs up. If you didn't, give me a thumbs down. Don't forget to leave a comment. And as I said at the beginning, make sure you subscribe to the channel so you can access all my previous videos. Don't forget to hit that notification icon so you're notified the moment my next video is released. Till next video, happy trading and good luck.